Customs Valuation, Determination of Value of Imported Goods, Rules, 2007 Rule 1. Rule 1 lays down the basic principle for valuing imported goods for the purpose of charging customs duty. What Rule 8 says? Rule 1 states that these rules are to be used to determine the value of imported goods when customs duty is calculated under Section 14 of the Customs Act 1962. In simple terms, customs value must be determined according to Section 14 of the Customs Act and these valuation rules. Purpose of Rule 8: to set the legal foundation for customs valuation. To make it clear that valuation must follow Section 14 and the Valuation Rules 2007 provide the methodology for such valuation. Rule 1 does not prescribe any formula. It only tells which law and rules must be followed. Key points of Rule 8. Applicability. Applies to all imported goods where customs duty is chargeable. Link with Section 14. Valuation must be done as per Section 14, Transaction Value Concept. Framework Rule. It is an introductory rule. Detailed valuation methods are given in later rules, Rules 3 to 9. Why Rule 8 is important? Without Rule 1, there would be no legal basis to apply valuation rules. It ensures uniformity and legality in determining customs value. It prevents arbitrary valuation by customs officers. Example, simple. If you import machinery into India, customs cannot randomly decide its value. They must value it as per Section 14, using Valuation Rules 2007, starting with Rule 1. Rule 1 establishes that the value of imported goods for customs duty must be determined strictly according to Section 14 of the Customs Act and the Customs Valuation Rules 2007. Rule 2 explains the meaning of important words and expressions used in the customs valuation rules. These definitions ensure that valuation is done uniformly and without confusion. Purpose of Rule 2: to avoid ambiguity in interpretation, to ensure consistency in customs valuation, to clarify technical and legal terms used in later rules. Important definitions under Rule 2. Ek adjusted value means the value arrived at after making additions or deductions as permitted under the rules. Example, adding freight, insurance, or royalty to the invoice value. Do buyer, a person who buys imported goods or agrees to buy goods or holds himself out as the buyer. Even if the title has not yet passed, the person can still be treated as buyer. Teen seller, a person who sells goods for export to India or agrees to sell goods for export. Char transaction value, the price actually paid or payable for the goods when sold for export to India. This is the primary basis of valuation explained in Rule 3. 5 identical goods. Goods which are same in all respects, produced in the same country, by the same producer. Minor differences in appearance are ignored. 6 similar goods. Goods which are not identical but have similar characteristics and composition, perform the same functions, are commercially interchangeable. 7 computed value. Value calculated based on cost of production, profit and general expenses, transport and insurance, used when transaction value is not acceptable. 8 deductive value. Value derived from selling price of imported goods in India, after deducting expenses like commission, profit, duties, etc. Nor royalties and license fees, payments related to imported goods that buyer must pay as a condition of sale. These may be added to customs value. Why Rule 2 is important? Acts as the dictionary of valuation rules, helps in proper application of Rules 3 to 9, prevents disputes due to misunderstanding of terms. Simple example, if customs compares your imported mobile phone with another phone, they will check whether it is identical or similar as defined in Rule 2. Only then can they apply the correct valuation method. Rule 2 defines key terms like transaction value, identical goods, similar goods, buyer, and seller to ensure correct and uniform customs valuation. Customs Valuation, Determination of Value of Imported Goods, Rules, 2007 Rule 3. Rule 3 is the most important rule in customs valuation. It says that customs duty should normally be charged on the transaction value of imported goods. What is transaction value? Transaction value means the price actually paid or payable for the goods when sold for export to India, plus certain additions specified in the rules. This is usually the invoice price. Main principle of Rule 13. Customs must first try to accept the transaction value. Only if it cannot be accepted, customs can move to other valuation methods, Rules 4 to 9. Conditions for accepting transaction value. The transaction value will be accepted only if all these conditions are satisfied. 1 key cap: no restriction on disposal or use. Buyer should not face restrictions on using or selling the goods in India, except restrictions imposed by law. Geographical limits. Minor restrictions that do not affect value. To key cap: no conditions affecting the price. The sale should not depend on conditions or considerations, which cannot be valued in money terms. If price depends on such conditions, transaction value is rejected. 3 key cap, no sharing of resale proceeds. Seller should not receive any part of resale, disposal, or use of goods in India, unless such amount is added to the value as per rules. 4 key cap, buyer and seller not related or relationship does not affect price. If buyer and seller are related, transaction value can still be accepted if relationship does not influence the price. Additions to transaction value. Even if invoice value is accepted, certain costs must be added, such as commission and brokerage, cost of containers and packing, value of assists, tools, dies, designs supplied free cheap, royalties and license fees, transport, insurance, and loading charges up to place of importation. When transaction value is rejected, customs may reject transaction value if invoice is doubtful or undervalued, conditions of Rule 3 are not met, buyer-seller relationship affects price. Then valuation moves to Rule 4, identical goods, Rule 5, similar goods, Rule 7, deductive value, Rule 8, computed value, Rule 9, residual method. Simple example, you import machinery for 10 lakh रुपए, freight insurance 50,000 रुपए, royalty payable 1 lakh रुपए, customs value 11 lakh 50,000 रुपए. Duty will be charged on 11 lakhs 50,000 rupees, not just invoice value. Rule 3 says that customs value shall be the transaction value, the price actually paid or payable, provided certain conditions are fulfilled. Customs valuation, determination of value of imported goods, rules, 2007 Rule 4. Valuation based on identical goods. Rule 4 applies when the transaction value under Rule 3 cannot be accepted. In such cases, customs will determine the value by comparing the imported goods with identical goods. When Rule 4 is applied, Rule 4 is used only if transaction value is rejected under Rule 3 and there are imports of identical goods available for comparison. What are identical goods? Goods are considered identical if they are exactly the same in all respects, are produced in the same country, are made by the same manufacturer. Minor differences in appearance are ignored. How valuation is done under Rule 4. Customs will look for the transaction value of identical goods, ensure the goods were exported to India at or about the same time, at the same commercial level and quantity. Adjustments allowed if there are differences in quantity, bulk versus small shipment, commercial level, wholesale versus retail, transport or insurance costs. Customs will make reasonable adjustments to arrive at a fair value. Order of comparison. Preference is given to identical goods with same quantity and commercial level. If multiple values are available, lowest value is generally adopted. When Rule 4 cannot be used, Rule 4 cannot be applied if no identical goods are imported around the same time, manufacturer or country of origin is different. In such cases, customs proceeds to Rule 5, similar goods. Simple example, you import a mobile phone, invoice value rejected, customs finds same brand, same model, same country of origin, imported last month at 20,000 rupee per unit. Customs value 20,000 rupee per unit after adjustments, if any. Rule 4 provides that when transaction value is not acceptable, customs value shall be based on the transaction value of identical goods imported at or about the same time. Customs valuation, determination of value of imported goods, rules, 2007 Rule 5. Valuation based on similar goods. Rule 5 is applied when valuation cannot be done under Rule 3, transaction value, and Rule 4, identical goods. In such cases, customs determines value by comparing the imported goods with similar goods. When Rule 5 is applied, Rule 5 is used only if transaction value is rejected and no identical goods are available for comparison, but similar goods have been imported to India. What are similar goods? Goods are considered similar if they are not exactly identical, have similar characteristics and material composition, perform the same functions, are commercially interchangeable, are produced in the same country, normally by same or different manufacturer. How valuation is done under Rule 5. Customs will find the transaction value of similar goods, ensure goods were exported to India at or about the same time, at comparable commercial level and quantity. Adjustments allowed. Adjustments may be made for differences in quality and reputation, quantity imported, commercial level, wholesale retail, freight, insurance, and transport costs. Selection of value. If more than one value of similar goods is available, the lowest adjusted value is normally adopted. When Rule 5 cannot be used, Rule 5 is not applicable if no comparable similar goods exist, differences are too significant to adjust reliably. Then customs proceeds to Rule 7, deductive value. Simple example, you import a washing machine of brand A, transaction value rejected, no identical brand or model available, brand B washing machine, same capacity, Same features. Same country of origin. Imported at 25,000 रुपए. Customs may adopt 25,000 rupees after suitable adjustments. Rule 5 states that when transaction value and identical goods value are not available, customs value shall be based on the transaction value of similar goods imported at or about the same time. Rule 6 does not give a valuation method itself. Instead, it explains the order in which rules 7, deductive value, and 8, computed value, are to be applied. Why Rule 6 is needed? After failure of Rule 3, transaction value. Rule 4, identical goods. Rule 5, similar goods. Customs must move to Rule 7 or Rule 8. Rule 6 clarifies which one comes first and whether the order can be changed. What Rule 6 says? एक normal rule. Rule 7, deductive value, shall be applied before. Rule 8, computed value. This is the default order. दो option to the importer. If the importer requests, customs may apply Rule 8 first and apply Rule 7 later. This option is only at the request of the importer, not customs. Meaning, in simple words, customs normally calculates value based on Indian selling price, Rule 7. But if the importer prefers value based on cost of production, Rule 8, customs must accept this request. Why this rule is important? Protects the importer's interest. Gives flexibility where deductive value is difficult to determine. Prevents arbitrary choice by customs officers. Simple example. Imported goods are not sold yet in India. Deductive value, Rule 7, is hard to compute. Importer requests application of Rule 8. Rule 6 states that Rule 7 shall normally be applied before Rule 8, but the importer can request reversal of this order. Customs valuation, determination of value of imported goods, Rules 2007 Rule 7. Deductive value method. Rule 7 is used when valuation cannot be done under Rules 3, 4, and 5. Here, customs determines value based on the selling price of the imported goods in India. What is deductive value? Deductive value means starting from the price at which the imported goods or identical similar goods are sold in India, and then deducting certain expenses to arrive at the customs value. When Rule 7 is applied, Rule 7 applies if transaction value is rejected, no identical or similar goods values are available, goods are sold in India in the same condition as imported or after minor processing, basis of valuation. Customs will consider the unit price at which imported goods or identical or similar imported goods are sold in India to unrelated buyers. Deductions allowed. From the Indian selling price, the following are deducted. 1 key cap commission or profit and general expenses. 2 key cap transport and insurance costs within India. 3 key cap customs duties and taxes payable in India. 4 key cap costs of processing if goods sold after processing. Condition of goods. Preference is given to goods sold in the same condition as imported. If not available, goods sold after processing may be considered with deductions for processing costs. Time factor. Sales considered should be at or about the time of import. If not available, earliest subsequent sales may be used. Simple example. Imported shoes sold in India at 5,000 rupee per pair. Less deductions. Profit expenses, 1,000 rupees. Inland transport, 300 rupees. Customs duty taxes, 1,200 rupees. Customs value, 2,500 rupees. Rule 7 determines customs value by deducting expenses and duties from the Indian selling price of imported goods or similar goods. Customs valuation, determination of value of imported goods, Rules 2007 Rule 8. Computed value method. Rule 8 is applied when customs value cannot be determined under Rules 3, 4, 5, and 7, or when the importer requests Rule 8 to be applied before Rule 7 as per Rule 6. What is computed value? Computed value means calculating customs value based on the actual cost of producing the imported goods, plus reasonable profit and other expenses. Components of computed value. Customs value under Rule 8 includes 1 key cap cost of materials and fabrication, raw materials, manufacturing and processing costs, 2 profit and general expenses, normal profit earned by producers of similar goods, general expenses in export country, 3 key cap transport, insurance and loading charges, up to the place of importation in India. When Rule 8 is difficult to apply, manufacturer may not disclose cost details, reliable cost data may not be available, foreign producer may refuse cooperation. In such cases, customs moves to Rule 9, residual method. Importer's right, important. Under Rule 6, the importer can request Rule 8 to be applied before Rule 7. Customs must accept this request. Simple example. Cost of production, 6 lakh rupees. Profit general expenses, 1 lakh rupees. Freight insurance, 50,000 rupees. Computed customs value 7,50,000 रुपए. Rule 8 determines customs value based on the cost of production, profit, and transport expenses when other valuation methods fail. Customs valuation, determination of value of imported goods, Rules 2007 Rule 9. Residual method. Rule 9 is the last method of customs valuation. It is used only when the value cannot be determined under Rules 3, 4, 5, 7, and 8. What is the residual method? Under Rule 9, Customs determines the value using reasonable means, consistent with the principles of Section 14 of the Customs Act and the valuation rules, and based on available data. It is a flexible method, but not arbitrary. Important conditions of Rule 9. By using Rule 9, customs must not determine value based on selling price of goods manufactured in India, highest of two alternative values, arbitrary or fictitious values, minimum customs values, domestic market price in exporting country, cost of production other than computed value under Rule 8. What customs can use? Customs may use earlier import data with flexibility, adjusted values of identical or similar goods, international price references, if reliable, logical estimates consistent with valuation principles. Nature of Rule 9. Fallback but last resort rule. Provides flexibility where strict methods fail. Must still follow fairness, transparency, and reasonableness. Simple example. No reliable invoice. No identical or similar goods. No Indian selling price. No production cost details. Customs may refer to past imports of comparable goods. Make reasonable adjustments. Arrive at a justifiable value under Rule 9. Rule 9 allows customs to determine value using reasonable and consistent methods when all other valuation rules fail, without using arbitrary or prohibited basis. Customs valuation, determination of value of imported goods, Rules 2007 Rule 10. Additions to the transaction value. Rule 10 explains what costs must be added to the invoice price to arrive at the correct customs value, provided these costs are not already included in the price actually paid or payable. Purpose of rule thus. Even if the transaction value, Rule 3, is accepted, the invoice price may not reflect the full value of the imported goods. Rule 10 ensures that all relevant costs up to the place of importation are included. What must be added under Rule 10? A. Commission and brokerage. Buying commission is excluded. All other commissions and brokerage are added. 2. Key cap cost of containers and packing. Cost of containers treated as one with the goods. Packing cost, materials and labor. Always added if not already included. 3. Value of assists. Goods or services supplied by the buyer free of cost or at reduced cost for producing imported goods such as tools, dyes, molds, materials used in production, engineering, design, development, artwork done outside India. Value of these assists is added proportionately. 4. Royalties and license fees. Added if buyer must pay them. They relate to the imported goods. Payment is a condition of sale. 5. Proceeds of subsequent resale. Any part of resale proceeds in India that goes directly or indirectly to the seller must be added. 6. Transport, insurance, loading charges. Freight, insurance, loading, unloading, and handling charges. Added up to the place of importation, Indian Port Airport ICD. Important conditions. Additions are made only on the basis of objective and quantifiable data. No addition can be made on assumptions or estimates. If a cost is already included in invoice price, it should not be added again. Simple example. Invoice value 10 lakh रुपए. Freight insurance 60,000 रुपए. Royalty payable 1 lakh रुपए. Packing cost 40,000 रुपए. Customs value 12 lakh रुपए. Rule 10 specifies mandatory additions like freight, insurance, royalties, assists, and packing to the transaction value to arrive at the correct customs value. Customs valuation, determination of value of imported goods, Rules 2007 Rule 11. Declaration by importer. Rule 11 places a legal responsibility on the importer to make a truthful and complete declaration of the value of imported goods and related information. What Rule 11 requires? The importer must declare correctly the value of imported goods, all relevant particulars that affect valuation. This declaration is made in Bill of Entry, supporting documents, invoice, contract, packing list, etc. Information to be declared. The importer must disclose, wherever applicable, the price actually paid or payable, relationship between buyer and seller, if any, details of royalties or license fees, assists, tools, designs, materials supplied free cheap, commissions and brokerage, freight, insurance, and packing costs, any condition or consideration affecting price. Why Rule 11 is important? Customs valuation is based primarily on importer's declaration. It ensures transparency, fair assessment of duty. Wrong declaration can lead to rejection of transaction value, penalties and confiscation under the Customs Act. Customs power. Customs officers may ask for additional information or documents, verify the correctness of the declared value. If declaration is false or incomplete, value can be redetermined under other rules. Simple example. If an importer declares invoice value as 5 lakh rupees, but hides a royalty payment of 1 lakh rupees, Customs can reject declared value, add royalty, impose penalty for misdeclaration. Rule 11 makes it mandatory for the importer to truthfully declare the value of imported goods and all related details affecting customs valuation. Customs valuation, determination of value of imported goods, Rules, 2007 Rule 12. Rejection of declared value. Rule 12 gives customs officers the power to doubt and reject the value declared by the importer, but only after following due process. When Rule 12 is invoked, customs may invoke Rule 12 if they have reasonable doubt about truth or accuracy of the declared value, genuineness of the transaction value. Doubt must be based on reasons, not suspicion alone. Procedure under Rule 12. 1. Raising doubt. Customs must communicate the reasons for doubt to the importer. Ask for further explanation or documents. 2. Opportunity to the importer. Importer must be given a reasonable opportunity to justify the declared value, produce evidence, contracts, payment proof, costing, etc. 3. Decision by customs. If importer's explanation is satisfactory, declared value is accepted. If explanation is not satisfactory, declared value is rejected. Value is redetermined under Rules 4 to 9. Important safeguards. Customs cannot reject value straight away. Reasons for rejection must be recorded in writing, defensible and logical. Principles of natural justice must be followed. Burden of proof. Initial burden is on customs to show reasonable doubt. After that, burden shifts to importer to prove correctness. Simple example. Importer declares value 8 lakh rupees. Customs data shows similar goods usually import at 12 lakhs rupees. Customs asks for explanation. Importer fails to justify difference. Customs may reject declared value under Rule 12. Rule 12 allows customs to reject the declared value after recording reasons and giving the importer a fair opportunity to explain. Customs valuation, determination of value of imported goods, Rules, 2007 Rule 13. Power to determine value using reasonable means. Rule 13 gives residual authority to customs officers to determine the value of imported goods when valuation cannot be done strictly under earlier rules, but still within legal limits. What Rule 13 says, in simple terms, if customs cannot determine value using Rule 13, transaction value. Rule 4, identical goods. Rule 5, similar goods. Rule 7, deductive value. Rule 8, computed value. Then customs may determine value using reasonable means consistent with Section 14 of the Customs Act. Principles of the valuation rules. Available and reliable data. What reasonable means. Customs may rely on past import data with suitable adjustments, comparable international prices, adjusted values of similar or identical goods, logical and defendable estimation methods. But no guesswork or arbitrariness is allowed. What customs cannot do. Under Rule 13, customs must not fix value arbitrarily, use minimum or fixed values, use Indian market price of locally made goods, use highest of two values, ignore principles of natural justice, safeguards for importer. Value must be reasoned, recorded in writing, justifiable if challenged. Importer has the right to know the basis of valuation, challenge unreasonable valuation in appeal. Simple example, no invoice, no comparable imports, no cost data available. Customs may use earlier import trends of comparable goods, make logical adjustments, arrive at a reasonable customs value. Rule 13 empowers customs to determine value using reasonable and lawful methods when all standard valuation rules fail without acting arbitrarily. Customs valuation, determination of value of imported goods, Rules, 2007 Rule 14. Penalty for contravention. Rule 14 deals with penalties. It provides consequences if an importer violates or fails to comply with the customs valuation rules. What Rule 14 says? If any person makes a false declaration or suppresses facts or furnishes incorrect or incomplete information or contravenes any provision of the valuation rules, such person shall be liable to penalty under the Customs Act 1962. Nature of penalty. Penalty is not automatic. It depends on nature of violation, intent, deliberate or not, degree of misdeclaration or suppression. Penalty provisions are applied under Section 112, improper imputation, or Section 114A, fraud, collusion, willful misstatement, etc. of the Customs Act. Situations attracting Rule 14. Rule 14th may be invoked if invoice value is deliberately undervalued, royalties, assists, commissions are hidden, fake or manipulated documents are submitted, relationship between buyer and seller is not disclosed. Link with Rule 11. Rule 12. Rule 11 duty to declare truthfully. Rule 12 power to reject declared value. Rule 14 punishment for violation. These three rules work together. Simple example. An importer declares value as 5 lakh rupai, suppresses royalty payment of 2 lakh rupai. Customs may reject value, Rule 12. Reassess duty. Impose penalty under Rule 14. Read with the Customs Act. Rule 14 provides that any contravention of the customs valuation rules, such as misdeclaration or suppression, attracts penalty under the Customs Act 1962. Customs Valuation, Determination of Value of Imported Goods, Rules, 2007. Rule 15. Rule 15 is a clarificatory and enabling provision. It empowers the government to remove practical difficulties that may arise while applying the customs valuation rules. What Rule 15 says? If any difficulty arises in giving effect to the provisions of these rules, the central government may issue orders, instructions, or directions. Do so in a manner consistent with the Customs Act 1962. Such action is taken to ensure smooth implementation of the valuation rules. Purpose of Rule 15. To handle practical or procedural problems. To ensure uniform application of valuation rules. No breakdown in valuation due to technical issues. To fill gaps or ambiguities without changing the law. Important limitations. Government cannot override. Section 14 of the Customs Act. Core principles of valuation. Power is administrative, not legislative. Meant for clarification, not creation of new rules. How Rule 15 works in practice. Used to issue circulars or instructions. Clarify interpretation of valuation provisions. Address operational difficulties faced by customs officers or trade. Simple example. A new valuation issue arises due to change in trade practice. Valuation rules do not clearly address it. Government may issue clarificatory instructions under Rule 15 to remove confusion. Rule 15 empowers the central government to issue clarifications or directions to remove difficulties in implementing the Customs Valuation Rules, 2007. Customs Valuation, Determination of Value of Imported Goods, Rules, 2007. Rule 16. Repeal and Savings. Rule 16 is the final rule of the Customs Valuation Rules, 2007. It deals with repeal of earlier rules and saving of past actions. What Rule 16 says? The earlier Customs Valuation Rules, 1988, are repealed. However, anything done or action taken under the old rules is not invalidated, will be treated as if it was done under the new 2007 rules. Meaning of repeal and savings. Repeal old rules are cancelled and no longer applicable. Savings past actions remain legally valid. This avoids legal confusion and protects completed or ongoing proceedings. Why Rule 16 is important? Ensures continuity of law. Prevents disputes like this action was taken under old rules, so it is invalid. Protects past assessments. Ongoing proceedings. Orders already passed. Practical effect. Imports made after 10 October 2007. Governed by Customs Valuation Rules, 2007. Actions taken before repeal. Continue to be valid. Simple example. A valuation inquiry started in 2006 under old rules. New rules came into force in 2007. That inquiry remains valid and continues lawfully. Rule 16 repeals the old valuation rules but saves all past actions, ensuring continuity and legal certainty. Subscribe for regular updates and expert content. Knowledge grows when you subscribe. Subscribe to learn something new every day.